Good morning, everyone. I am so happy that all of you have decided to join us today. And I also might say good afternoon to some as we're crossing time zones at this particular time. But thank you for joining us today. My name is Amy Shamoon. I'll give you a little bit more details on the speakers and backgrounds in a few moments. But today we're going to be covering transfer pricing, cash saving strategies, and the new audit roadmap post-tax reform. We're going to cover some general information right now, and I would also like to mention that as moderator, I also have some co-moderators in here, so you'll hear my voice at times when I'm not on the screen, as well as my other colleagues, Emily Robinson and John Boehm today, as we work through the next hour with you. So thanks again for joining. Before I introduce the main featured speakers today, we're going to go over a couple of housekeeping items that are very important, especially if you need CPE.
Thanks, Amy, for the introduction. So here are some of the housekeeping items for audio and handout materials, CPE, and question and answers. If you are experiencing audio issues, try logging out and logging back in. You can download the slides from for this presentation in the handout section of your control panel. And we will also have a couple polling questions throughout the presentation. So please keep an eye out for those, and those will appear on your screen when we go to launch them. If you do need CPE, please go to the handout section again and download the two forms. So that is a sign-in sheet and a class evaluation sheet. Both will need to be filled out and sent back to cpe@pkfmueller.com to receive the full credit, along with meeting the 15-minute requirement. So any questions about CPE, please send an email to, again, cpe@pkfmueller.com or pkfmuellerservices@pkfmueller.com. And again, if you have any questions, please submit them in the questions box, and we will do our best to answer all of those questions during the presentation. Also, feel free to add any comments into the chat box. And with that, I will hand it back to you, Amy.
You know, in thinking about transfer pricing, and I was thinking about this yesterday as I'm just glancing through the slides that our speakers are going to cover today, and I know I've had lots of discussions with our clients about transfer pricing, and some of them viewing it as a daunting compliance checkbox item that they need to deal with. But today, the message comes across that we're really looking at transfer pricing from a tax saving strategy and ways to improve your cash flow as you work through the different, especially the different jurisdictions you may be located in. There's also transfer pricing within the United States at a national level when you're in a lot of states, which most clients now these days file in many different states. So there are opportunities in transfer pricing among the states. That will not be covered today. Our main focus will be transfer pricing as it relates to global businesses. I would like to talk about our featured firm today. PKF Mueller, we have teamed up and partnered with KBKG. We've been working with them for a few years now, and I have been PKF Mueller has been working for Alex Martin for probably maybe inching up upon 2 decades now. KBKG has been around since 1999, offering specialty tax services and advisory services throughout the nation. And as you can see here, I won't read off every bullet item, but the most important item we're covering today, of course, is transfer pricing services. And they have specialized professionals serving in all those different specialty tax items that you see listed there. Cost segregation and R&D credits is very hot with our clients. We also assist in the IC DISC area as well. KBKG offers turnkey solutions to CPAs and businesses. Their engineers and their experts have worked on thousands of projects that they've been very successful at. They're located in quite a few different states throughout the United States: Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, and a few others. And their headquarter office is located in the state of California, which is one of the highest income tax states that is very challenging for some of our clients to maneuver through. They're a preferred provider to us as well as other CPAs. And a lot of the audience on the webinar today knows our firm very well. I'll just cover a couple of the items. We're a full service public accounting firm serving domestic clients as well as clients located in various different jurisdictions. We have the list of our services listed right there. But what I wanted to call your attention to, as most of you are operating in multiple jurisdictions, is we're members of the PKF International Network. So we are able to work with our clients located in other jurisdictions. The network that we're a member of, they have over 400 offices. They have members in over 150 different countries. So we're able to share our resources and really be able to help our clients in every different facet of business that they need, it from a compliance perspective to advisory type services. Another item that we're really proud of as PKF Mueller is we've won the best places to work in Illinois now for 11 consecutive years in a row. Now we're going to roll into a couple of different introductions. Hi, everybody. Obviously, this is me. I'm an international consultant, and I'm leading up, along with a team, our international services for the firm. I have a diverse client base and act as the tax liaison with PKF International Network. Now to talk about our featured guest speakers, my colleague Scott Simpson, who is an international tax director in the firm. He has over 30 years of experience working with large multinational companies. He's worked with many Fortune 500 tax department experience executives, international tax planning, compliance issues. He's worked in many different industries, as well as I have: accounting, manufacturing, healthcare, retail, professional services. And last but definitely not least is Alex Martin, our featured guest speaker today from KBKG. He's a full-time transfer pricing specialist, and he's been dedicated to transfer pricing for over 24 years. He's worked overseas for quite some time as well. He is an economist and has Big Four experience, worked for the Big Four for 12 years, 6 years working in the middle market CPA firms, for firms such as PKF Mueller, similar in size. Prior to joining KBKG, Alex's transfer pricing team was selected as one of the world's leading consultancies by International Tax Review for the past 3 years. Alex has also been an advisor for World Bank, working with tax auditors in Bosnia. And with that, I'd like to turn it over to our presenters today, Alex Martin and Scott Simpson. All yours.
All right. Well, thanks so much, Amy. We really appreciate the opportunity to be here with PKF Mueller and well, JCM. I've been friends of the firm for a good 10+ years, so it's a great opportunity to talk through multiple things. And also, yeah, thanks to you for joining. Appreciate you taking the time to come out. We appreciate the time for you to listen to the webinar here, and hajime mashite to our friends, our Japanese clients who have come to join as well. A couple things we're going to talk through here, and it's all about making sure to look at transfer pricing from a practical perspective. So we're going to be talking about identifying, assessing, and discussing transfer pricing, coming up with strategies from, again, a practical perspective. So what are we going to cover? Well, we're going to talk about opportunities and some red flags, whether it's the first time you've come across transfer pricing or maybe you do this every day. We think there's some good rules of thumb that you can run with. The IRS is actually been quite successful on the transfer pricing realm recently, and we're going to talk about Coca-Cola, which actually maybe you're not as big a company as Coca-Cola, but it may be very relevant to you going forward. We're also going to be talking about some transfer pricing audit rules of the road, whether it may be the IRS or other countries. They're all quite important. But we're also going to be practical about identifying tax savings, and that might be an overlooked opportunity, especially in this COVID environment. Other things, Biden tax plans and global tax developments, very important. And there have been some recent agreements, and this is breaking news, on a global minimum tax. And finally, we're going to highlight some special areas here as we go, some transfer pricing takeaways that we expect you'll be able to use on a go-forward basis. Now, one thing that's going to be nice here is, not just me talking about the economic side of things. Scott's also going to be interjecting with some of his observations from how to improve transfer pricing from a day-to-day management perspective, and also some pitfalls you may want to avoid as time goes on. So with that, let me just jump in with an example, real-life example of how transfer pricing works, why it's important. And let's just take a German manufacturing plant that is selling auto parts to a US distribution subsidiary. Well, depending on the price charged on a cross-border basis, that's going to drive how much tax you pay. Now, if you charge too high a price from the German manufacturing plant, well, the IRS is going to be unhappy because they're not getting their fair share of tax. Conversely, if the German manufacturer charges too low a price, the German tax authority is going to be unhappy. While we're talking about auto parts here, it really doesn't matter. Goods, royalties, service charge, loans, pretty much if there's a multinational company with a cross-border transactions, there's a transfer pricing in play. I'm not just talking about taxes either, there's also some cash impacts too.
Thanks, Alex. So here's another example on the easy side. And I've seen this a lot in practice over the last couple of years. My example is that, let's say we have a U.S. parent that needs some R&D work done over in Canada. And that U.S. parent company basically has two options on how to go about doing that work when it comes to having people in Canada. Option A, they can simply go out and hire a third-party service to do that R&D work for them. Mm-hmm. Or they could hire their own person and open up a subsidiary in Canada. So where the transfer pricing comes into play here is frequently the U.S. parent thinks, well, if we go with option B, I can just pay them their costs. It's intercompany, it all washes out to zero. Doesn't matter. Well, it does for transfer pricing purposes. Canada is going to want to tax that entity in their country. So if we're paying that employee $100, typically we're going to mark that up to an arm's length rate. So in this case, what's the arm's length rate? Well, if we had gone with option A and hired a third party to go out and do that work, and let's say that person spends $100 to do the R&D work, well, when that firm charges the U.S. parent, obviously they're going to mark that up to make a profit on their services. So let's say it's 110. So if we go with option B, perhaps 110 is the correct remuneration, cost plus 10. Depending on the country, it could be cost plus 5, 7, 20.
Really does depend on making sure you can explain to a Canadian tax auditor that you've got a reasonable level of profit at the end of the day.
Yeah, and in addition to discussing it to the auditor, you're going to have to talk with people on the ground at the U.S. parent or in Canada and explain how this all works. And at the end of the day, this all winds up on a tax return.
Exactly. And why don't we just do another, maybe a bit more newsworthy situation that might be particularly relevant for a lot of companies. Let's take Starbucks, for example, and this is one of my favorite examples. Starbucks buys coffee beans in an exchange in Switzerland. They sell coffee beans to Starbucks in the Netherlands, which does the roasting. Starbucks in the Netherlands sells those roasted beans to the UK, where they have retail operations all over the the UK. Also, Starbucks in the UK pays a royalty over to the US for use of the brand name, use of the intellectual property, pretty much everything that makes a Starbucks a Starbucks. The question comes down to, from a transfer pricing perspective, where should profits be generated? Well, a bit of a trick question there, but one place where Starbucks didn't have any taxable income was in the UK. And effectively, a lot of activists took over Starbucks outlets all across the UK. Why? Well, Starbucks had paid tax once out of the previous 10 years. Now, Starbucks said, well,
in the UK.
In the UK, exactly. So Starbucks said, well, the reason we lost money is because we made some bad decisions on where to rent. The rents are too high in central London, and therefore we're incurring a loss. Everybody else said, well, hold on a minute. You're buying coffee beans from the Netherlands. You're buying, Switzerland's getting their profits, and oh, by the way, the US company's getting their royalty. We think we're being cheated out of our fair share of tax. And oh, by the way, the other companies, coffee companies operating in the UK are paying tax. Why can't a large multinational like Starbucks do that? So basically, Starbucks was hauled before Parliament, along with Amazon and Google and a number of other companies. But why are you manipulating your accounts to avoid tax? So I'm not sure if I know of another tax issue which actually can be a reputational problem too. So in this case, the activists took over Starbucks outlets and turned them into homeless shelters for the day. So this really did damage the Starbucks brand. What can you take away from this? Well, tax auditors often argue that subsidiary companies should not incur losses. And that insight, I think, is actually really helpful on figuring out how to manage your transfer pricing going forward. Let's do another example, a little more recent. Coca-Cola actually lost a very large tax court case where Coke licenses its trademarks, its product names, logos, what have you, all across the world. And the IRS came to the table and said, well, we think you're undercharging your subsidiaries all over the world. We think you should have more taxable income in the US. So, and this is not this isn't a typing error or typo. It actually is a court case covering 2007 to 2009. The court case came out last November, and the IRS issued over $9 billion in transfer pricing adjustment. Even for a big company like Coca-Cola, that's a lot of taxes that are due. And so what's the insight there? Well, hey, tax auditors like the IRS often argue that subsidiary companies should not earn excessive profits. We're kind of got a balancing act there. We want to make sure we're paying one country the right number, and also the subsidiary side.
And we have to make all countries happy. And the transfer pricing is not a US-centric concept anymore. It's all around the world. So we have to deal with it everywhere.
And as we go along here, these insights, they really are applicable worldwide. So we think you'll find them helpful regardless of where you're operating. All right, so we're going to have our first question. Hey, what are your top transfer pricing challenges? We like to address them as we go and make sure we're answering your questions as we go.
Yeah, thanks, Alex. So at this time, type in the chat now, what are some of your top transfer pricing challenges? So we'll give our attendees maybe about 30 seconds to type in their answers.
Yeah, a couple of good questions. Yeah, are there state transfer pricing issues? Definitely. For those separate entity states, they do in enforce transfer pricing rules. Fortunately, the transfer pricing rules on a state basis are also broadly consistent, if not the same as the IRS transfer pricing rules that we'll cover. Okay. Great.
Well, we don't have necessarily a challenge, but we do have a question from somebody. So maybe we want to address that now.
Sure.
So that question is it best to collaborate with each of the countries involved to minimize the tax effect of transfer pricing strategies?
I think it's very helpful to look at it from maybe a holistic point of view to some extent. You got to make sure you're balancing things. So that's something you handle on a daily basis.
I wouldn't necessarily tell people in country X what you're doing in country Y as far as pricing at the forefront. You may be requested to provide that kind of data. But yeah, you as the taxpayer, you need to look at the transfer pricing you're setting with all of your intercompany cross-border transactions. Make sure that what you're seeing, to you is fair. To the tax authorities, they always have the opportunity to question. So
yeah, so kind of balancing that from
it's a yes answer.
Exactly.
With qualifications.
Well, all right, so what companies are affected by transfer pricing? Well, effectively every US company with international operations, every international company with US operations. Again, it doesn't matter what the transaction is. If there's a transaction going across and it affects taxable income when one country versus the other, there's a transfer pricing issue in play. And just to be clear, over time, more tax authorities are focused on the results of transfer prices rather than policies. So a lot of companies will have great policies, which are very helpful, but they aren't, if the results aren't turning out the way they are supposed to, then there's some heartburn.
So you've kind of blown your documentation. Not to jump ahead here, maybe you have this later in the slide, but Alex, what if I have a disregarded entity reporting up to another foreign parent?
I think the disregarded question is something that's overlooked quite often, but if you do have a disregarded entity from a U.S. tax perspective, there are transfer pricing rules in play because
when you go cross-border.
Exactly, you're going cross-border, and while it might be disregarded from a U.S. tax purposes, you still might be losing out on, let's say, some foreign tax credits too. So that's, I think, a great point on sometimes it's a misunderstanding that regardless of the structure, regardless of the transaction, transfer pricing may be in play here too. One nice thing, and I guess that I'll put that in quotations, is that the U.S. transfer pricing rules under Section 482, the arm's length standard, is effectively the same rules worldwide. So what's the question here that's coming to play? I should charge the same price as if we were unrelated companies. Now, that's great in theory, but I think sometimes that's a little more difficult to apply in practice.
How do you prove that you're doing that?
So, yeah, again, I guess when I started, there were probably 10, 12 countries that really enforced transfer pricing. Well, as you'll see, it's a very great revenue raiser. And so the arm's length standard really, applies in over 100 countries now because, well, everybody's figured out that it's a great way to raise revenue, and also everybody else is enforcing the same thing. All right. So why don't we just talk a little bit, and I think Scott will also have some great insights here on how some companies approach transfer pricing. And let's take the case of a U.S. pharmaceutical company that's come up with a cure for the common cold. They have a subsidiary in France. They're selling ingredients over, and they're also charging a royalty for use of the manufacturing intellectual property. Well, what's a transfer pricing question? Well, what's the price of the ingredients? Too high from one side, too low from the other? And also, is the royalty, quote unquote, arm's length? Well, what I find a lot of times we'll ask a couple questions like, well, how did you come up with transfer pricing in the first place? Well, we've got a cost plus 10 policy. Where did it come from? Sometimes it's just the last thing companies think about because, well, let's just call cost plus 10, and it may work well for a good 5-10 years, but especially now that we're in a COVID environment, that cost plus 10 might not work as well anymore.
And that's correct. Yeah, I've seen auditors come in and challenge all kinds of rates being used, and if you say that you have the right rate, they're really going to push hard on you to prove why you believe that is an arm's length charge.
And why it's correct, and how did you benchmark it?
Exactly.
The second thing that comes into play quite often is that the company's looking at profits on an overall basis. They're focused on, let's manufacture for the lowest price possible and not sell for as high a price as possible. Let's maximize the overall profit. And that makes a lot of sense from an operational point of view. However, they don't necessarily worry about where the profits end up. It's US, France, doesn't matter, it's all the same company. Tax authorities don't have that same perspective. The US is looking at the IRS is looking at how much profits in the US. The French tax authority is looking at how much profits in France.
And each party wants to maximize their cut.
So even though you run your company as a whole entity, the tax authorities are going to ask very different
have
questions.
A narrow focus. I'm talking to you about my country.
Exactly, and look, they may not know anything about your company, but they do know how much tax you pay, and that's really a driving force. But that also can be a helpful rule of thumb to think about when you're planning your transfer pricing. And the third item here may be a little surprising, but another question we ask is, somebody's bonus affected by the transfer price? So what we'll say sometimes is that the managing director of the plant in the US figures out that if I can charge $1 million to my sister company, I get a bigger bonus.
More revenue.
More revenue on their side. It looks like you're doing better on how you're manufacturing. Well, great, but you're also you're paying more tax in the US than quote unquote arm's length prices, and you're creating exposure on the French side. So quite often transfer pricing can be a diplomatic exercise too, because you got to make sure that you're not creating heartburn over bonuses, because, well, there can be some game playing there. What's the insight there? Well, transfer pricing exposures may have absolutely nothing to do with aggressive tax strategies. So, and it's not the intent, it's the results that come into play. All right, so, well, what happens if a tax auditor disagrees? Well, as you'll see, it gets really expensive. Let's assume for example purposes that there's a transfer pricing adjustment of $10 million. So in other words, the IRS says you should have charged an extra $10 million to your subsidiary. Well, let's assume for right now that we've got depending on how the Biden tax plans work out, that we've got a tax rate of 25%. So you'd owe additional tax of $2.5 million on that $10 million of additional income. Plus, they've got non-deductible penalties because it's a large transfer pricing adjustment. So what does that mean? Well, in this case, you've got $3 million worth of tax plus interest, because it takes a while to solve these issues, plus US state taxes, and a potential double tax issue. Because guess what? When you get an IRS transfer pricing adjustment because they think you're not paying your fair share, what are they saying on the French side? We don't necessarily agree with that. And they're not going to give you a refund automatically. So effectively, yeah, you've got a lot of tax that's double tax. You've got a very expensive tax bill, and maybe you can get relief from that, but it may take 3, 5, maybe even longer to get the refund on the other side.
And how does this process all get started? The IRS comes in and says, we're going to audit your tax return. And lo and behold, you get an information document request saying, please show us your transfer pricing documentation.
So again, when this started, 20 plus years ago, maybe it was 8 countries that were doing this, or 8 to 10. Over time, we've got over 100 countries now that have similar transfer pricing regimes, and it's a great way to raise revenue. I'm not arguing over meals and entertainment expenses. I just think you've been ripping us off for the last 3 to 5 years. That's a very different mentality, very different discussion, and you're hearing it from all angles. All right, so what can you do about it? And I think this is, if you've come across transfer pricing before, you might have heard of transfer pricing documentation. Now, there are 10 items in the US transfer pricing rules, but here's what it generally includes. It's an analysis of how the business operates in the US and internationally, who's doing what, who's bearing what risk, what's the value add of the company as a whole. Is it from marketing? Is it from R&D? Those are the kind of things that are supposed to be in reports. An industry analysis, how does my company fit by comparison to competitors? A financial analysis of the company and the intercompany transactions, and then why is the transfer pricing correct, or quote unquote arm's length?
And you pointed out that you're looking at an analysis of the transactions. That's plural. They can look at each line of business, getting down to what are their products you're selling and where are they sourced and how do they differ from your other products. There can be multiple adjustments coming along the way from an IRS audit, just based on what it is that you're selling.
And there's some best practices here, I think, that are really important. If you write a report that says to the IRS that, hey, we're overpaying tax in the US, we don't worry about it. Well, what if a Canadian tax auditor gets hold of the exact same report? They're going to have heartburn because you're saying, well, if I'm overpaying tax in the US, I'm underpaying tax in Canada. So, but another nice thing about these transfer pricing rules is that this transfer pricing documentation is effectively very similar worldwide. How does my business work? It's your first and best opportunity to explain what's going on. So if you're trying to get a handle on, well, maybe I've seen these reports before, maybe I haven't, but I'd suggest reading a report, and if there is one, reading a report, and if it doesn't make sense to you, if it's outdated, it's not going to make sense to an auditor. So that's important to think about, because that's your first and best opportunity to avoid an adjustment in the first place, or an audit for that matter.
Couldn't agree more.
All right, so what happens if you prepare this transfer pricing report? Well,
and Alex, do we have deadlines when these things are due?
Exactly. The deadlines unfortunately vary by country, but you need to have the report prepared by filing date of the tax return. So we just finished October 15th deadline, so that was difficult to say the least. But effectively, now the contemporaneous documentation, contemporaneous meaning the time you file the tax return, effectively it just needs to be, it's not something you submit with a tax return, but and it's not a guarantee that the IRS is going to agree with you. All that being said, If the IRS disagrees with your transfer pricing, but you have a transfer pricing documentation report, they won't assess penalties. So I think that's something that gets really tricky sometimes, because when do I do a report? What does it guarantee for me? You know, how do the penalties apply? And sometimes I think there's some misunderstandings, because it is a complicated situation.
Usually what you have to have is a near final draft available on the date that that tax return is filed. But then obviously you don't have to produce a final until the IRS requests that.
And so,
which may or may not come.
Yeah, which may or may not come. And I know a lot of companies haven't necessarily been hit by an IRS audit in recent years, but we find that's
once you do, it's going to be ugly.
Yeah, if you're not ready. Now, one thing that's, I think, also misunderstood is that the reports need to be updated annually. So you write a report once, you need to update it on an annual basis to be, quote unquote, contemporaneous. Why? Well, you're supporting your answers on a tax return. That's what this report is effectively doing. So I've highlighted this in yellow just because I think it's misunderstood quite often. Reports need to be updated annually to be contemporaneous. Now, that doesn't mean you have to do the interviews or discussion points. That being said, if you write a report once, the updates are usually a lot less time intensive, and yeah, it's not as much in terms of resources.
Whereas the larger the company, the larger the transactions, potentially you need to be paying attention to your transfer pricing methodologies more frequently than just once a year.
Yep.
As one of our colleagues was discussing with us earlier today, you may want to be looking at your transfer pricing on a quarterly basis, maybe on a monthly basis, if that's a significant portion of your business. There's potential tax saving strategies, and why wait till the end of the year to find out what those are and try and utilize them?
And I think one thing that we're seeing, especially in a COVID environment, is that moving away from just looking at this as a compliance issue really can bring some much needed cash and tax savings in the door. All right, so let's give you some additional insights. The IRS and these transfer pricing documentation rules came back in 96, 97. But the IRS said, well, you know what, we're getting these reports from a lot of different places, and we aren't real comfortable with the quality of the documentation. So again, we'll hammer on this quite a bit, but it's really your first and best opportunity to educate the IRS on the key functions and assets and risk by country. They're specifically saying, giving us a checklist isn't sufficient. We want to understand what the business circumstances are, what's affected profitability, and how. Maybe just as an aside, I've been doing this 20 plus years because I really enjoy learning about, hey, what makes your product, what makes your service better than everybody else's, and you really do.
Why are you unique?
Exactly. So, why not take that opportunity to do it? So the other thing that's out there is that the IRS audit practice now is that if you prepared an analysis with a best method, we'll talk about that a little bit, but if it's reasonable, they will accept your thought process, your analysis, which actually can make a big difference between an audit and having them walk away.
Yeah. And a one-pager transfer pricing policy isn't necessarily going to get you out of any bad audit results. And the larger the company, the more frequently, I mentioned you need to look at your transfer pricing, but we keep talking about just the U.S. You need to get in touch with your foreign affiliates, make sure they're keeping their documentation, because that's going to roll into most likely a local country transfer pricing report, and an IRS agent can request those as well.
And I think that's really important, because you may not, sometimes the subsidiary will do a transfer pricing report and you don't know about it, and it probably, it may say something really bad from a US perspective. So having that kind of coordinated approach can make life a lot easier. So if you're working with certain countries, let's say Mexico, for example, it's required. Ask for what that transfer pricing report is, review it, understand what it means, not just from a local country perspective, but also from a US perspective as well.
And that's also a great option for you to actually go and visit these facilities to see for yourself, what are they doing, what are they making, how's it being done. And back to that point of, what is it we are doing that makes us unique in our marketplace that allows us to charge more than our competitors?
And they're not going to know unless you tell them.
Yeah.
Absolutely. I'd like to add something to that too. Some of the clients that have been audited by the IRS, closer to the smaller mid-sized type company, transfer pricing documentation wasn't contemporaneously put into place for some of the clients, and you've got 30 days to turn that around. If you've got that in place, and when they issue you that IDR asking for that transfer pricing information, you're able to turn that around within a day or two of their request, they're most likely going to say, okay, they've done their job, and they're not going to be scrutinizing every single detail. Whereas if you wait until that 30-day mark, because you've been scrambling around with a service professional to get the documentation in place, they're more likely to scrutinize every single detail within your report.
Exactly. And again, they are used to, some companies, it's not required from an IRS perspective. You're not necessarily required to do the documentation, but if you don't, you're leaving a lot up to chance. Yeah. All right, so what do you do? How do you figure this out? Well, we think there's some fairly straightforward off-the-shelf company information that's going to make life a lot easier on figuring out whether there's a problem or not. And normally what we do is ask for country by country income statements. So income statements segmented on for each country where you operate for the current year and the previous 3 years. Let's look at what profits are for all open tax years. On the US tax return, effectively look at those for the last 3 years too. Why? Well, these forms 54, 71, 72, basically they disclose to the IRS what the transactions are, what's the volume, and effectively which countries are involved. The other thing is there any existing US or international TP documentation? Again, you want to know what the story is already, and if somebody's written something fantastic, let's make sure it's right.
Yeah. Yeah, and back to your point of the 5471s, et cetera, there, we've got a team here at PKF that's keeping on top of all these international form changes and new rules that are coming along. And hopefully nobody has a controlled foreign corporation and has not filed one of these forms.
Yeah, and the reason being is that if there's a $10,000 fine or a $25,000 fine, depending on what the transactions are.
And it can leave your statute of limitations open since the date that company did not first file.
And the reason being is they want to know what the intercompany transactions are, because it is such a big revenue issue for them.
And, of course, for years we had the whole deferral regime on the international front, where the U.S. company can make money overseas, and if they didn't repatriate that money back to the U.S., it wasn't taxed, unless, of course, for subpart F. Then in 2017, we also brought along the guilty regime, which we'll talk about later, which is another deemed inclusion back on the U.S. return in certain circumstances.
So where does this leave us? Well, look, from a sanity check point of view, for lack of a better term, do the results make sense? Does it make sense that your subsidiary company is incurring losses in Mexico or the UK or China or what have you? Well, if there aren't profits ending up there, if you're not paying tax there, you're probably creating some heartburn from a foreign tax auditor perspective. Second thing is, or alternatively, if we've got a Coca-Cola situation where the profits are you're earning too much profit overseas. Well, those are the kind of things you want to think about. And it's difficult to come up with a one-size-fits-all margin because the car and automotive industry is going to have much slimmer margins than, let's say, the pharmaceutical industry. But to the extent you know your company and you know your industry best, you can actually get a handle on, from a global point of view, where the issues are and where you want to spend your time. Second thing is, hey, what's the volume of intercompany transactions? You don't want to waste your time on a $50,000 transaction when you've got a $5 million or $50 million transaction elsewhere. And finally, hey, are the reports reasonable? Again, does it pass that smell test? Would it make sense for somebody new to the company to understand what's going on? And just as for the very largest companies, and we're talking the $850 million in revenue, there are actually now specific, what are called master files and local files that you're required to prepare. Again, just because countries worldwide are interested in making sure the very largest companies are paying their fair share.
Yeah, those are kind of like the subsidiary filings that go along with your country by country report.
So where does this leave us? Well, for sometimes for some of the smaller companies that may not necessarily need a full documentation report, sometimes what we'll do is have what's called a transfer pricing benchmarking study. And effectively what this is to figure out, well, how much profit should a subsidiary earn? And I've just put an example. This is what's called the comparable profits method or transactional net margin method. We're not going to do a deep dive on the different methodologies, but effectively it's a more practical way in certain circumstances to come up with a target range of profits for subsidiary companies. Basically, you're looking for companies that do broadly similar functions in these different countries. It's not penalty protection. It's not a guarantee. Again, if it's
but it becomes a source for why you're charging what you are charging.
Exactly, and
there's lots of details behind this. You could be looking at business-to-business transactions. You could be looking at business-to-consumer transactions. You could have different ranges applicable with the same benchmark companies.
And you may say to yourself, well, I've never heard of these companies before. Well, that's okay. The reason a lot of times you're not going to hear these companies before is because you're comparing them to the subsidiary that's doing, the more routine work, as opposed to all the R&D, artificial intelligence, what have you, on the parent side. So again, this certainly isn't a one-size-fits-all, but sometimes it's a nice practical solution when it's necessary. Now, can you get a guarantee on transfer pricing? Well, yes, you can.
Well, you can get very close. Years ago, the IRS came out with what is known as an advanced pricing agreement. It's a form of documentation, kind of like a reverse transfer pricing report, in so much that you spell it out to the IRS. You give them all the details about your intercompany transactions and methodologies. The idea is you're basically preparing a proposal, and you discuss this with the IRS, and you clean it up. You guys, the two parties, come to an agreement that you've sufficiently documented it. Here's why we're charging what we're going to charge. And if the IRS agrees to it, you're good, unless facts change. Do you really want to lay it all out on the line to the IRS? Do you want them to know every little thing about what you're making and how it's made, where, and what's being charged everywhere along the line? It's a cost versus risk benefit. These agreements last for 5 years. I've done these in the past. It takes about 3 years to come up with a 5-year together. And by the time you and the IRS agree to it, you agree on your final documentation, you turn it over, it's now applicable 2 years retroactive, current year, 2 years forward. And you have to annually give the IRS an update on how things are going. And typically by the time you get everything agreed to, you guys start working on your renewal for the next 5-year period.
And a great question just came through. Do these APAs apply for other countries? Short answer is yes. Certainly a lot of countries are very proud of their APA program because it does give some certainty in certain situations where it's a very complex issue. It's a very risky issue. I guess it's difficult to say, hey, this is something you should run with because it is expensive. It does take a lot of time, blood, sweat, and tears, again, for lack of a better term. But it does take a long time to negotiate, and wow, it's a lot. It's
in a perfect world, you do it once and you just keep renewing it. The IRS never audits you on your transfer price.
Which sounds great, but it's not an agreement you just tread into lightly. It can be a very difficult concept. Let's jump to polling question 2.
Emily, have you got this?
Yep, so I just launched the polling question. So the question is, what is an appropriate time to consider and plan for cross-border transfer pricing? And we did have some character limits, so sorry about some of the short answers here. But we have 4 options. So the first is when planning to add new foreign subsidiary. The second, when considering the correct import value of goods for custom purposes. Next, only after the foreign country location has incurred profits or losses of 1 million. And the last, it is always time to consider and review cross-border transfer pricing. So I see some answers coming through. I'll give them just a couple more minutes or seconds.
I think a great question that just came through is just are transfer pricing policies and agreements helpful? And I think that unequivocally yes. It's always helpful to have intercompany agreements, I think, first and foremost, just so you can be very clear about which country bears what risk.
Yeah, internally you have to be clear at first before you even get around to document and your taxability.
Same thing with policies. It's helpful so everybody knows what the rules of the road are. Make sure that the transfer pricing isn't playing with somebody's bonus. And sometimes, I have come across a number of companies where they spend, unfortunately, 50% of their time arguing over transfer pricing and trying to put out those fires. It's a waste of time and resources when we're just talking about a situation where we just want to keep the tax authorities happy and make sure we're getting cash and paying the right amount of tax, and end of that. Another great question about is transfer pricing documentation required in some countries? Short answer is yes. And the reason being is some countries, particularly Mexico, even if you've got around $1 million in revenue, you're required to have transfer pricing documentation to comply with local sign-offs from a tax perspective. And there's actually disclosures that say, do you have transfer pricing documentation?
Yeah, it's kind of part of your due diligence when you open up a foreign subsidiary. You need to know what are the transfer pricing rules in that country,
and so,
as well as obviously the income tax rate, withholding tax.
And some of it's based on revenue, local revenue. Sometimes it's the volume of transactions, for example, in China. And then,
they can look at your asset base and, what are you doing with all this equipment?
so yeah, great question there. Should we jump back?
Yeah, so sorry, Alex and Scott. Didn't know how many questions you would answer there, but for the polling, it was 71% said it is always time to consider and review cross-border transfer pricing. So I think that was probably the right answer. Otherwise, 21% they answered planning to add a new foreign subsidiary.
Oh, well, I think that's important too. All right, well, let's jump into some tax savings. And I think this is something that, especially in a COVID environment, that is overlooked and really can make a big difference when cash is tight at the end of the day. So where do we take this? Well, like we said, transfer pricing impacts where profits and losses accrue by country. So one thing that we find is a great opportunity, both from a tax savings point of view and also from a compliance point of view, is to look at where tax net operating losses are. So what we're saying here is that transfer pricing can be an overlooked opportunity or an impediment for companies that are struggling with COVID-19. And I think insight number 8 here is that correcting transfer pricing to utilize tax NOLs is a 2-for-1 overlooked opportunity here. Let's put some math behind that. All right, so let's say we've got the German parent with the U.S. company subsidiary reseller, $70 million in U.S. revenue, they're purchasing in euros, and they're facing a market downturn. So let's assume that the parent company's got $6 million in taxable income at a 30% rate, so $1.8 million in tax. And the U.S., but looking at the U.S. company P&L, well, you can see that the revenues are going down, and they've gone from minimal profit down to break even, and then in 2021 we're in a loss situation. So mining it all over a 3-year period, well, we've got a small loss. And again, I'm focusing on earnings before interest and tax. Reason being is it's easy to calculate and it's easy to put your thumb up and check what the margins are by country from again, a sanity check point of view. So where does this leave us? Well, is the IRS going to be happy with the situation where we've got a loss? Probably not. I think
they could ask.
They can ask. And there's actually been some middle market audit campaigns for targeting those types of companies. All right, so IRS is having some heartburn here. All right, so, well, and from an IRS point of view, they're saying, well, hold on a minute, with an independent distributor, if I was distributing your product and I was losing money year after year, would I keep doing that and losing money, or would I renegotiate pricing? All right, well, let's take an example where just for 2021, we said, well, let's reduce the transfer prices by $2.5 million. Well, that helps reduce the IRS audit risk because we're moving at least from, instead of a loss situation, at least we're at break even. That's better than nothing. But there's actually the tax savings opportunity. Germany is going from paying $6 million worth of tax or taxable income to 3.5. Well, if you're working off a 30% rate, that's $750,000 in cash tax savings right now. That's overlooked, and that's something that can be done now for 2021. A couple great questions that are come up here. What's a German tax auditor going to say? Well, I think at the risk of sounding a little flippant here,
they're going to disagree.
They may disagree, but the response to that is, well, hold on a minute. A, if the tables were turned, you wouldn't like the losses, and B, I hate to say it, but you've probably been we've probably been overpaying tax in Germany for the last couple of years. And second question really is, well, are you allowed to do this during the year? I think a best practice is to make that change, especially during the year now, as opposed to defending what's happened in the past. So making that change, yes, you can cause some questions, but at the end of the day, we're trying to address the transfer pricing issue, especially with COVID going on right now. Well, that's as good a reason as any for making that change, because business situations has changed. Exactly. And what else can you say? Yes, you can point out that the U.S. company has been losing money from year after year, or sales have gone down, but it's harder to make that argument. A lot of times companies will say, well, we purchase in euros, so therefore that's why we have the loss. Yeah, you can make that argument, but their response, and I've heard this many times, is that, well, the parent company should be bearing that foreign exchange risk. So those are the types of arguments that come into play. But if you can get ahead of the situation and figure out, well, where are the profits and where should they be, you're going to be way ahead of the game. What else can we do?
So there's another planning strategy. It's also a requirement depending on your size. You may have executives in the United States that are implementing global policies around the world, and some of those costs can and probably should be allocated back out to the foreign subsidiaries. So you might be reducing some tax in the United States, or that's the company's desire. Here's a way to do it. Bringing on somebody like KBKG or myself, you can look into the facts of what the various departments at, say, headquarters do in the United States, and come up with a methodology on how to push those costs out to the foreign subsidiaries. The IRS does not expect or want you to keep all those expenses in the United States, because that's lowering their tax collection at the end of the day. But by charging those out to the foreign subsidiaries, you're reducing tax in those countries. So you can't use that as your end game to not fairly charge the other offices, but fair charges will pass scrutiny with the IRS, and depending on the breadth of how much you're charging out, the IRS may, where's the documentation on this? And like I said, if you've done the studies with the executives, come to an agreement on how much of their work is benefiting the foreign offices, you've got an ironclad story to tell.
And that could be,
have the documentation.
And that could be HR, that could be the IT services, that could be sales support. But hey, if there's a real benefit there,
if your accounting office is having to do the books and records for your subsidiary in Malaysia, push that cost up. Back to my original simple little example of the cost plus 10. If you're going to do it internally, you got to be compensated properly.
That also has a big impact on cash flow too.
Yeah.
Well, I think maybe here's another example of I think that's really important, especially given all the supply chain issues you may have heard. Well, I think maybe not heard, but you're experiencing at the moment. Let's take a parent company in country A that's got a $2 million loss, or basically let's say there's a market downturn, they've got a $2 million loss. And they've got a manufacturing subsidiary in country B. Right now, they've got a $5 million in profit at a 30% tax rate. So they're paying about $1.5 million in tax. And they're selling $10 million of inventory over to country A. Well, does it really make sense, again, from a effective tax rate perspective, that country B should be paying $1.5 million in tax when we've got big losses on the country A side? Well, look, business has changed. Maybe the transfer prices of inventory in the situation are too high. Maybe country B shouldn't be getting that really cost plus large X% margin for their operations. So right there, $2 million transfer pricing adjustment, 30% tax rate, $600,000 in tax. And again, that's the overlooked opportunity. All right, so let's go to polling question 3, excuse me, I'm good at reading today.
Next polling question is, have you faced a transfer pricing audit? Select one of the following: yes, US only, yes, international only, yes, US and international, or no, not yet. We'll give our attendees a few seconds. All right, we've got about 50% voted, and I'll share the results. So we have 100% no, not yet.
Okay, well, there you go.
We have some lucky people.
Yeah, I think so. All right, so, and I think that's why it's helpful to talk about the tax savings too.
And I'll tell you what, Alex, I mean, I've been here in the Chicago area now for 12 years. Worked over in probably 3 or 4 different large companies. And, you know, everyone jokes about IDR number 1 is always, give me your tax return. Well, every place I was at, IDR number 2 was give me your transfer pricing report. So it was always there. The IRS, you know, they still keep it at the forefront because, like you've mentioned, Alex, it's kind of low-hanging fruit for them. If you don't have the documentation in place, they're going to move your transfer price for you, and more than likely they're going to move it such that you're going to be paying the IRS more in tax.
And remember who's reviewing it too. It may not be your local IRS agent. They may be sending it to the economist in Washington, D.C. That may be a 23-year-old kid for all you know. So, I mean, those are they may
Could
have
be a 57-year-old that's been doing this for 30 years.
You don't know.
Yeah.
And, you know, maybe there might be some expectations there, or unrealistic expectations there, depending on who you come across. All right. Let's, I guess, jump over to tax court and global developments. And actually, there's a bit of this is probably breaking news, but I would like to talk about Coca-Cola again, just because it is such a powerful audit tool, frankly, for our audit template for the IRS I see going forward. Now, Coca-Cola and the IRS have been arguing about this for a long time, and actually Coke said, well, we had a closing agreement back in 1996, and we're just applying the exact same approach as before. The tax court said, well, A, that tax closing agreement didn't apply going forward, and 2, so basically, just because the IRS agreed with your transfer pricing before doesn't mean it has to respect or agree with the transfer pricing going forward.
Right.
So Coke kind of said, well, here are the facts. We think the subsidiaries bear a lot of marketing risk and they've incurred substantial costs, so therefore they should get a larger share of the profit. Basically, the IRS came back and said, no, it's really the independent bottlers that you work with are taking the marketing risk. And you know, does it really make sense that a low-risk contract supplier should earn excess profits? And I pulled this slide together, but basically, let's just think about it from a sanity point of view. Here's a return on operating assets. Well, the average food company gets about a 10% return on assets. Coke US or Coke globally gets a 53% return on assets,
which is a much stronger brand
than anything else.
Yeah.
Pretty much anything. But then you look at Coke Mexico, Coke Swaziland, of course, Coke Costa Rica, up to Coke Ireland, and you say, well, hold on a minute. does it really make sense that Cook Island should get a 200+% return on their assets?
Gee, aren't they a little low on their tax rate?
Yeah. So those are the kind of things where it jumps up that it might be a little problem. So what does this mean? Well, the implications here is that, hey, it's a huge win for the IRS and a very first one in a long time, very expensive for Coca-Cola, and it is a template. If you're a US company earning lots of profits overseas, that probably doesn't pass the smell test. So we see that as a template for big tax adjustments. So what are the observations? You want to review the annual profit margins for each subsidiary. The subsidiaries incurring losses, well, that's a subsidiary company tax risk. Large profits in the subsidiaries, we've got the Coca-Cola situation. So all open tax years. Now, to be clear, that's not the final answer, but that helps you identify where the issues are. And like we were saying before, monitoring transfer pricing during the year is really helpful too.
We got that balancing act. Where does the profit really belong?
And again, like that, we briefly touched on this before, but Mexico, they require documentation at $1 million. India, that has so many business process outsourcing, they've got very high expectations of what service charges should be, sometimes cost plus 20. And I think the other thing is you just want to make sure the reports are consistent across all countries and from year to year. Breaking news. Yeah, this is, there have been longstanding discussions about a global minimum tax. And really just earlier this month, over 136 countries agreed that there really should be a global minimum tax of 15%. This will probably happen in 2023. However, some of the largest companies are certainly would be are affected by this, maybe not as many as small companies. And there's also some new taxing rights on digital sales, your Amazons, that kind of thing. So does that global minimum tax resolve transfer pricing issues? Well, from my perspective, really not. And the reason being is that even though it's a backstop for companies to pay a 15% tax wherever they are, it's still much more lucrative for them to have a transfer pricing audit than to rely on this global minimum tax. So again, while that's going to hit the news, it's certainly much more valuable for them to generate more profits.
Yeah, and it's an OECD suggestion, right? So
it has to be implemented.
It has to be implemented, and you know, OECD says this is what our number is, 15% at present, but it's up to the tax authorities, the governments in each of these countries to decide on, you know, what are they going to accept as your minimum.
All right, so guilty taxation, that's probably more worthwhile to think about from a U.S. perspective.
Yeah, so as we probably all know, GILTI's been around with us since tax reform in 2017. It was the U.S.'s approach to the early discussions about what should be the global minimum tax. Long story short, the IRS picked 13 1/8% as their minimum tax rate. They came up with a rather complex calculation on how you get to what effectively is just another kind of a deemed inclusion, like the old subpart F. You're making too much money in certain countries where you're not paying enough tax, the U.S. is going to top it up. GILTI itself will probably be, you know, our final bullet point here is more impactful than the global minimum tax, simply for the fact that it's a hard and fast rule, a lot of complexities into the calculation, but at the end of the day, when you put it all on paperwork, on your tax return, it looks kind of simple, and you can see the numbers, and wham, there's your tax pickup. So, all right, so let's go to polling question 4. We're pretty much we're close to the end here.
Okay, I've just launched the last question here. My client and I would like to discuss a possible transfer pricing issue with PKF Mueller, more information about transfer pricing with PKF Mueller, or I'm not interested at this time. So we'll go ahead and close that, and we'll just move on with the rest of the presentation.
Well, let's just summarize the 10 takeaways, and I hope you found this helpful and practical. From look, tax auditors argue that subsidiary companies should not incur losses. We've seen that in multiple areas. Tax auditors argue that subsidiary companies shouldn't earn excessive profit margins. Well,
So you gotta be in that range.
yeah. The arm's length
A range.
Yeah, so the arm's length standard applies worldwide, so it's not just the US, it's pretty much everywhere other than Brazil, frankly.
And that has ballooned in the last decade.
Yeah, so transfer pricing exposures may have nothing to do with tax strategies, and if you do come across a transfer pricing report, does it make sense? Because does it make sense to you? It's not going to make sense to an auditor. Reports do need to be updated annually to be contemporaneous, highlighted in yellow. The IRS is much more likely to accept your position if you prepared the documentation. Tax savings, if you've got tax NOL somewhere, looking at transfer pricing, let's use them. CocaCola is going to be a great template for the IRS, unfortunately. And then, yeah, transfer pricing audits are going to be a high return as investment, even with a global tax. So with that, certainly you can download these slides, but if you have any questions before we close out here, first off, thank you so much for joining us. We really appreciate it and the questions that have come through.
And we do have actually quite a few questions.
Oh, okay.
So I will try and go through all of those.
Uh-oh.
So first one is it best to collaborate with each of the countries involved to minimize the tax effect or transfer pricing strategies? And I actually think that was a question already answered.
Yep.
Okay, so the next one is, does this transfer pricing apply to custom imports?
Yes, it does. Unfortunately, the customs rules are different than the transfer pricing rules. So you're not allowed to pay a lower customs duty on the cost of goods sold and higher on from a tax perspective. So unfortunately, you can get whipsawed there, but they both are very important together.
And I learned 20 years ago that an IRS agent cannot go behind your back and go talk to the customs people to find out what the prices are being listed as at that point.
And I think it's helpful if you are going to adjust your transfer pricing on cost of goods sold, and there actually may be some customs duty savings too. So it works both ways.
Sure. Next question, is there a practical way to use transfer pricing for smaller companies over incurring hefty costs for services on full-blown transfer pricing documentation studies?
I think that benchmarking study is a really great middle of the road, because it's not the full documentation where you have to interview everybody, but it serves as a nice foot in the door to make sure it's right, and it's something that you may actually be able to use on an annual basis.
Study gives you a better answer than the smaller company that says we're just going to do cost plus 10, move on.
Yeah. So yeah, I
mean, there's your easy answer for the smaller company.
Yeah, I think the benchmarking studies I found to be really helpful, just to make sure we're on the right path.
If I do transfer pricing in one country, say the parent or headquartered company, how does this documentation compare to other countries, and can such transfer pricing policy be used in other subsidiary countries?
I think it should be. I think that's a best practice.
Yeah, your company policy should be we're going to look at all of the transactions in all the countries, and we want to make it fair for everyone. Is the documentation different in a foreign country? Probably, but it's going to be quite similar.
Agreed wholeheartedly.
Do APAs apply to my assembly operation in Mexico?
The Mexican tax authority does allow you to negotiate APAs. It's not as intrusive or complicated a situation as a U.S. APA. I guess long story short, for a lot of companies have maquiladoras in Mexico, and a lot of times it's easiest to rely on the safe harbor down there.
Yeah, a lot of countries do have these safe harbors where they're looking at, you know, the smaller countries are going to look for a cost plus, and if you're doing that, you're good.
So next question is, what is the #1 benefit of effective transfer pricing?
Cost savings.
I think there's a cost savings. I know I appreciate that there's tax audit risk, but just being able to have cash in the right place to, if you need to invest in a foreign subsidiary because you want them to expand, fantastic. Transfer pricing can help you do that. And yes, we're talking about the compliance issues, but having transfer pricing help put the cash in the right location really is an overlooked opportunity. And I think that's, you know, when we work together, we want to start with, well, where do you need
Yeah,
cash?
if you can move your internal cash where it's needed, you don't have to go out to a bank, borrow, and pay interest.
Exactly. So perhaps surprising, but I think the cash savings is probably the best, especially in this environment.
Great. Well, that is all the questions we had. So thank you for answering those. And I think Amy is going to conclude our webinar.
There's a lot of buttons to push to make sure you guys can hear me and see me. So
There we go.
thank you to Emily. Thank you, Scott. Thank you, Alex. It's a great presentation today. There's a lot of information. Thank you, everybody, for attending. I do want to remind you that if you need CPE to provide the information to us at your earliest convenience, and we'll get those CPE certificates out to you for today's event. As I mentioned, you know, transfer pricing is not easy, especially the more jurisdictions that you've got. And efficient transfer pricing should allow you to free up cash and recognize tax savings where you need to, and hopefully so you don't accumulate losses in a jurisdiction that you may temporarily lose or not be able to lose permanently. So all countries are entitled to their fair share of taxes, whether we like it or not. But do know it is not a perfect science, that there is a little bit of art that can go into transfer pricing, and with the proper planning you can get to the results that you need, making sure you're not overpaying taxes in any other jurisdiction. So with that, thank you everybody for attending today's event, and have a great rest of your day.
Thank you.
Thanks, everyone. Have a good day.
Bye.